Okay, so this video is going to cover Section 11, Real Options. And as we walk through this, you'll notice that we're going to be using two of the skills we've already covered in this class. We're going to be using a DCF, or discounted cash flows, and we're also going to be using what we just learned about, the Black-Scholes model. But before to get some of the concepts of real options, it's really useful to look at mutually exclusive options. So the idea here is that these are options that you can only choose one of them. If you choose one of them, that makes the others impossible. And there's a couple reasons why this might be the case. The first would be that the projects that you're considering rely on a single scarce resource. For instance, you might only have one plot of land, and you need to figure out what project will best utilize that plot of land. Another reason this might come about is that projects might fill a single need, or I guess a similar need. And so you don't need two of them. Okay, so let's look at a more concrete example by looking at problem 6.1a. So your company owns some land that can either be used to build a mall or an office complex. The mall will cost $4.2 million to build and generate $800,000 a year. The office complex will cost $4.5 million and generate $750,000 per year. The OCC for the mall is 18% and the office is 16%. And so what's the best option to choose? Okay, so let's first consider the mall. Well, this is a pretty simple valuation, right? We're just going to use our standard NPV rule. So the NPV of this project must be the present value of the perpetuity that this setup has, less, of course, the investment cost. So the perpetuity is the cash flow we're getting every year divided by the discount rate, less the initial cost. So we have an NPV of 244.4. Okay, so that's the mall. Now let's look at the office. And so the NPV is, I guess this construct is very similar. We're again going to take the present value of the perpetuity less the initial investment. And in this case, we're going to get $750 per year, and our discount rate is slightly lower, so 16%. And the cost of this was $4,500. So we get an NPV of 187.5. So just considering these two projects, of course, we would pick the higher NPV project. So under this under the known facts of this case, we would definitely choose the mall. But this is just one thing to consider. Or maybe a better way to discuss this is that just adopting a project might avail other options on those projects. And so that's essentially what these real options are. So a real option is are those options that come up because you've already chosen a project. So once the mall or the office are which one is chosen, there might be additional opportunities to expand or improve the cash flows on those options. And so let me just clear this out, and we'll talk about the types of real options you might want to think about. So the first one, as I've already kind of mentioned, is the option to expand. And this is probably one of the clearest ones that might come to mind when we think about real options. And so you might think about examples could include things like contracts that have an expansion option. So the idea is, after a kind of a pilot program, you have an option to expand. So you use the pilot. Currently the pilot looks very promising, has a high MPV, but the true test will be when it actually goes live, and then you might want to have an option to expand once you find out whether the pilot is a success. Something that might be less thought about is you might also want the option to abandon. And so the idea is, kill a project once it's no longer profitable. And sometimes it's not thought of as much, is it might actually cost money to stop. So something that comes to mind is, coal mining, or mining in general. So once you have decided to close the mine, you will likely have to pay to fill in all those holes that you created in some kind of rejuvenation project. Okay, continuing other types of real options we can consider or think about. Number 3, there's production options. And what do I mean by this is you might want to allow for customization of your product, or slight changes to product. You can think about different styles, colors, or features. And then finally, in these kind of general types of real options, we have timing options. And so far in this class, we've been using this NPV rule, where positive NPV projects we accept. If they're negative, we would reject. But even if a project has a positive NPV, there may be a best time, or an optimal time. So the idea here is you might want to wait a bit to see, or at least wait for some uncertainty to confirm itself, or to go away. So it might be best to kind of hold off, see how a trend or market is developing, and then launch your project. So as I already mentioned, the idea in these real options is that accepting a project might open up these additional opportunities to accept future projects. But this might, in your mind, this might kind of complicate how we do our deciding. So that's where this principle of optimality comes up, or comes into play. So how are we going to make sure that we are, logically consistent in our decision making? We're going to assume that any future decision will maximize NPV, just like we've been doing. So just as the current one does. Okay. And to help that, or to help kind of understand where we're making decisions, it's helpful to use a decision tree. So this is a mapping of all the alternative options we have. Then we can successfully map out each branch, and then see the value if we end up on that branch, and knock out ones that clearly are not the best options. So similar to the binomial tree, we'll map out all the branches and then work back, figuring out which projects and options result in the best valuation. So let's walk through an example, and this will hopefully clarify this in your head. So problem 6.1b. So after 1 year, the office complex can actually be expanded with an additional cost of 1.4 million. This raises future cash flows by 220 per year, 20,000. So the question is, should this expansion be taken? And if this expansion is possible, should we actually choose still the office, or should we choose the office, or should we stick with our decision on the mall? So to help think through this out, again, we could think about a mapping. So what are our options? We could do the office, we could do the mall, or we could do nothing, reject both. So those are our options at time 0. But that will kind of depend essentially on what happens, or what our choices are at time 1. So with this new layer of information in 6.1b, we have, if we choose the office, we have this option to expand or to not expand, to reject. So essentially now we have more options than we did before. We had 3 options, and now if we did the office, we could either expand or not. Okay, so let's value these pieces and figure out if this is going to change our answer. So the first step is to figure out what the value is created by simply doing this expansion. Okay, well, let's walk through that below. So the NPV at t equaling 1 on this expansion, because that's when it's going to be taking place, would again be the present value of the perpetuity of this project less the investment cost of this expansion. So very similar to what we had before. We get 220 a year. Our discount is 16. And our cost of doing this expansion, we're told, is 1.4. So in this units is 1,400. And this NPV is actually negative 25. So clearly we would reject this expansion. So what will happen now is we can now revise our decision tree. So if we clear this out, essentially we now have a tree where we have the option of office, and we know if we choose the office, we would choose do not expand. So we knock out that extra branch of expanding because we know that that's not the best option under the principle of optimality. So we could do the office without expanding, we could do the mall, or we could reject both. And given the evaluations that we did before, we would know that we know what the mall by itself is worth. If the office is chosen at time 0, the NPV is worth the NPV of the original plus the expected value of the NPV of the expansion. Well, given from above, we know that the original project was worth 187.5. Well, given that we're not going to expand, because we recognize that that was not the best option, the expected value of that expansion will be 0. If it turned out that it actually was profitable, we would enter it there. Or since the reason I'm talking about an expected value is there might be a range of possibilities on this option, and we would take the expected value and enter this here. But given that we know for sure that we would not expand, the expected value is 0. So the office project is still worth the same as it was before at 187.5. So given this problem in totality, we know that from above, the mall would give us an NPV of 24.4. The office without the expansion is this 187.5. Doing nothing, of course, will give us an NPV of 0. So we are still with the decision of choosing the mall project as our best option. Okay. So that seems pretty clear. We're just using our DCF valuation tools to value the separate options and choosing options whether or not they have a positive NPV and working our way back. The next section is now going to work off of, at least on this expansion idea, is to use the Black-Scholes model. Okay. So recall when using this model, we have some inputs. So we need to know the present value of the strike price. We solve for this D1, which is in your notes. It relates the stock price, the strike price, and the variation. We also have this D2. And recall that we calculate those numbers so we could put in to the this phi is again recall that this is representing the CDF of the normal distribution. Okay, so it's a lot of just plugging in and chugging. And on the call, what is it? The call formula is you take the current price, look at the normal distribution of D1, so the CDF, and then we subtract out the present value of the strike price times the CDF of the what you get out of using the CDF and D2. Okay, so that's how we value a call. Okay, so if we're going to use the Black-Scholes model in evaluating a real option, what would we need? We need a lot of the equivalents. I guess the one thing I didn't write in here is you of course need to know what the current stock price is, right? Okay, so what are the equivalent inputs when we're thinking about a real option? Well, of course, we're going to need to know what the underlying asset is. And so here it's the project, right? So we're going to use the DCF, discounted cash flow, just like we have, or just what we did at for the first part of this course. Okay, so that should be pretty straightforward. The next piece, just like in the stock, using the Black-Scholes model for stock options, we need to know the variance of asset price. And again, the asset price here is the project. Well, how do we know possibly the variance of this project that we're thinking about adopting? We don't have any history to use. Well, the history that we could use is we could use comparable companies. So already you may have noticed that this might be may not be the best valuation tool for certain projects, because namely you might not be able to find companies that you think are comparable to the project that you're trying to value. But if you do, perhaps you can use Black-Scholes to value your real option. Okay. The next thing we need to consider, or what is the discount rate. Of the exercise price. So we generally use the risk-free rate. And essentially what the idea here is that the Black-Scholes formula or model assumes that exercise price is fixed. And so hopefully if you're going to be using this for evaluating a real option, this is also the case in your scenario. Okay, the next topic I want to bring up about this is downside risk. Well, just like in evaluating options, this should not be relevant, because options essentially, from the purchasing standpoint, you're generally cutting off the downside risk, because since it's an option, you have the right to exercise, but you don't have to, right? No obligation to exercise. This is, of course, from the perspective of the purchaser of the option. When you're buying the right to exercise, but you do not have to. And then, when using this model, this decision rule is going to be the adjusted present value. So APV, adjusted present value. What does this equal? Well, APV equals the NPV of the original project plus the NPV of the option. So pretty straightforward. Okay, so essentially once you solve for these inputs, you can just insert them into the Black-Scholes formula as before for an option to expand. So as you recall from above, one of the other real option categories is timing. So let's explore that with another example. So 6.1c. And so, and just to back up a bit, on the timing option, essentially what you're trading off is you might want to delay construction or some kind of project because you would really like some uncertainty to resolve. But there's this trade-off, right? You're trading off this lowering of uncertainty versus trying to capture cash flows sooner. You already know this project has a positive NPV, and so it'd be really nice to bring those cash flows in the door. But if you can delay and those cash flows will actually be bigger, that would be a reason to delay. Okay, so problem 6.1c. After 1 year, the office complex can be expanded at a cost of 1.4 million. This raises future cash flows by 250 per year if demand is high, and 150,000 if demand is low. So recall from before, we just had some kind of fixed rate. The probability of high demand is 70%, and the state of demand will be known before an expansion is done. Assume a risk-free rate of 10%. Which project, still this mall or office, should be chosen in this case? Okay, so notice that here, if we just wait this 1 year, the uncertainty will resolve. We will know the state of the world, whether it's a high demand or low demand market, and so then we could use it. So to begin this, let's again look at this decision tree to see what our options are, or to at least understand the mapping. Okay, so we have at time 0, and then the state of nature is revealed. It could be high demand or it could be low, right? And then finally we get to choose. So if it's high, we could choose to expand or reject. If it's low, we could also choose to expand or reject. And then back in the broader sense of the problem, we still have the choice of just doing them all, or we can reject both. But given that we already know the mall is profitable, that would not be likely. Okay, so again, we're going to solve out this option in order to figure out whether or not the office is now finally a better option than the mall. Okay. So let's look at the high demand situation. Okay, so NPV when t equals 1 for high, well that's again going to be the PV of perpetuity minus the investment, and so we have 250 divided by the 16% less the cost of expansion to get 162.5. Okay, so clearly we would accept, right? Therefore, that's an acceptable project. To be clear, we're still at t equal 1. And of course, if we discount that, that's still going to be positive, so we're good. Okay, what about low? The NPV, again, t equaling 1. With a low state of the world, we're going to take the present value of the perpetuity minus the investment. And in the low state of the world, we'd only get 150 per year. Our discount rate does not change, and our costs would be the same. So in a low state of the world, we would actually get negative, I'm running out of room here, sorry. That's a 462.5. Okay, so clearly it's negative, so we would reject. Okay, so now what does our tree look like? Well, we still have the office, but we now know if it's high, we would expand. When t equals 1, so this is the state being revealed. If it's low, we would reject. So now we've simplified this tree, right? We've cut off 2 branches, and then we still have the mall option, or I'm just going to say nothing. Okay. So now we got to figure out what the valuation of the office is given these possibilities. Okay, so now, the expectation might make a little more sense. Okay, so let's think about the NPV of the office when it's t equaling 0. Well, that's just going to be the NPV of the original plus the expected value of the NPV of the expansion. Okay? Well, if you look above, you'll note or recall maybe that the original project was 187.5, and then the problem told us that the probability of high demand was 70%. So we'll value that by the valuation that we got, right? We would accept if it's high. The value at time t equaling 1 was 162.5, so we discount that back 1 period. And then our remaining 30 is for the low state, and of course we were going to reject that, so we get nothing in the low state, and we could discount that back, but of course that's still 0. Okay, so the NPV of the office project at time 0 is, well, actually let me write this out so you can see both values. You get still the 187.5, and then we have 98.1 totaling 285.6. Okay, so notice that the option value, if we were just wanting to evaluate the option of this expansion, now it's 98.1. So that it actually has value because we are able to wait and then determine what the state of the world is, whether it's high or low demand. Recall that, so that's the office. Our mall choice would give us 244. So now you could see that clearly the office with expansion is the best project under this scenario. So we would accept the office project. Okay, continuing on to the next kind of general real option type, we'll just talk briefly about the abandonment option. Okay, so for all the projects that we've been looking at for this course, I've generally been telling you what the project life is. So we have some kind of fixed project life, but it's not always clear that the life of the project is known when you start it. It might be hard to predict what the actual life will be, and it might depend on how successful it is over time and how the project evolves over time. So instead of having a fixed project life going in, and there might be better to have a flexible modeling choice that will not impose a fixed life. It will essentially endogenize the life of the project. And so how would you do this? Well, first you would forecast a range of options. Over several years. And I guess to add the flexibility, you would even you would map this out even beyond the expected life. Because there would be that rare chance, or at least non-zero probability, that it could go further than expected. And similar to what we saw with the options, you could use some kind of binomial tree. Okay, and then what you would be doing, just like we did with the binomial tree, is we would value the project at each node. And take into account the abandonment value. And you would essentially decide to quit, or decide, I guess, when to quit. Depending on what path you end up on. To make this a little clearer, why don't you look at Figure 1, which I've now brought to the screen. So the idea is you would map this out over several years, and at each of these nodes, you're looking at the the cash flows that you're getting in that specific time period, as well as what is the valuation of the asset given all the possible cash flow outcomes to the right. So again, you would kind of split up up and down scenarios and map this out. And so then you might get to some branches where if you were here, the reason I'm shading and pointing this out is you would decide to abandon here, and the reason you decided to abandon there was because you decided to abandon here and here, and it would just spread out. So as you can see, it's more endogenous, right? If you have several periods of bad outcomes, essentially the project is going to die. But if, on the other hand, you have a series of good options or good outcomes, then that's going to make you want to continue the project until you get into bad outcomes, or the cash flow is no longer supportive of the project. Related to this idea of abandonment, it might also be useful to temporarily abandon a project, so not permanently. And so, why might that come up? Well, or why would you at least consider temporary abandonment? Some factors to consider. The first one is it easy to shut on and off production? So kind of an extreme example of this at the other end would be, it's not easy to turn off and on completely a nuclear power plant, but it is clearly easier to use more or less gas or coal to turn up or down the amount of energy you're trying to produce. Related to this idea of just easiness to shut on and off is, what are the costs related? So the costs to shut down, generally not free, and turn back on. So is it quick? Is it easy? Does it cost a lot? And you might also, or you should also consider what kind of costs are incurred while it's shut down. Another consideration to think about is, are prices volatile? And likely to come back. So what do I mean by this? It could be either your input costs or the costs or the price of the the item you're trying to sell. So if they're volatile, are they going the right way? Or, if they're volatile, could they come back to favor you? So maybe it might be good to temporarily shut down, and then when prices come back in your favor, you can get production back online and continue on your way. Okay, so let's now continue to flexible production. So that was the final, or one of the more general production types, or options, real option types. And this is just the idea that it might be easier or better to invest in costlier production techniques or equipment in order to quickly adapt to changes in demand. So let's see an example for this. So problem 6.2. Pan World Airlines is currently negotiating a contract to buy some planes. It wants to purchase 10 planes that will be delivered in 4 years, and each plane will cost $25 million and produce cash flows of 4.4 for 20 years. Half of the purchase price is paid now, and then the rest at delivery. Pan World also wants to purchase an option to buy another 5 planes to deliver in 7 years for the same price. The option would have to be exercised no later than in 3 years. What is NPV of the project without the option? And what is the value of the option if the planes end up earning $4.6 million every year? How about if they earn $4.2 million? And let's use a discount rate of 12%. Okay, to step through this, let's first think about, or just to simplify matters, let's just think about the NPV of one plane. Well, first let's recognize that the cash inflow isn't going to happen for a while. We make the order, and then we have to get to wait for the plane maker to make the plane, and then we get our plane and can start making money. Okay, so this is going to be a delayed annuity setup. So I'm giving you the general formula here. So there's our annuity, and I need one more bracket. We're told that we have to pay half of the cost now, and then we pay the remaining at delivery. So we'll discount that as well. Okay, so now let's just plug in. So our discount rate was 12%. We'll put that to the fourth. That's how many years we get to wait. We're told that we will get 4.5 per year in cash flow. We're discounted by 12 still. These planes are going to create cash flow for 20 years, and they're going to cost us 25. We paid half of it now, and then the other half in 4 years. Okay, we do this math, and we get 442.7. So that's the present value of one plane. We are told that we want to buy 10 planes, so we just multiply that by 10, and the present value of this cash flow, this project is worth about $4 billion. Okay, the second part of the problem asked about this option and what the option value would be depending on how cash flows change. Okay, so let's first consider this scenario where these planes could get 4.6 million per year. Well, under the option, we're actually not going to be seeing any cash until quite a while. They'll be delivered in 7 years, and so then we won't get our first payment until 8. So we'll discount by 7. Again, under the scenario, we're going to get 4.6. Our discount rate is still 12%. And these planes are also still going to be in operation for 20 years. They're just going to start later. What do we have to pay? Well, we have to pay, we're told, we can use this option in up to 3 years. So we'll pay half of the price in 3 years, and then we'll pay the remaining at delivery. So the option value per plane is 990 under this scenario. Okay, for the 4.2, we do a similar analysis or similar formula, and I'm just going to plug in directly. So it's still delayed for 7 years. Now we get 4.2. And the payment structure is the same. Paying 25 in 3 years, and the remaining at delivery. Okay, let me just try to squeeze this in. On this scenario, our MPV is negative 360.7. It's hard to see. 360.7. So clearly, that would not be favorable. Okay, so the value of the option is valuable if it turns out that we get more than we originally thought. So that's not too shocking. But essentially what this is showing is some type of sensitivity. The original project valuation was based off of assuming a 4.5 cash flow per year. If this actually falls down to 4.2, we see this soon becomes not profitable, though here we were valuing the option. If you did a break-even analysis, you would find out that you need at least, let me just clear this out, or not. The break-even point is you at least need about 4.3 per year. And so this is what I'm trying to point out is when evaluating these projects, it's very useful to do sensitivity analysis. So when you're doing that, so analysis, what are you doing? You change each input variable one at a time. And see what how the valuation changes. So what do I mean by that? Well, you can change the net cash flow. Slightly change that over time. Perhaps you want to delay, or at least add in some delay time. So what if the project falls behind? Given that we just did an airplane example, these airplane manufacturers, at least in recent history, have not been on time with the deliveries. So maybe you want to factor in, or at least see if the project is still deliverable if it gets behind in time. What if we change the expected life? Of course, we could see how things change as we change the discount rate. And so those are just some of the things that you might want to look at when really testing to see whether or not the project has a positive NPV. Now note, when thinking about this option, we didn't have to vary the cost because that would have been locked in on the contract. So a change of that should not be too relevant, or at least you need to get better lawyers if they become relevant. Okay, so to close out this section, let's talk a little about how real life might make these real options more complicated. So real life complications of real options. Okay, so the first thing I wanted to bring up was complexity. You might be able to depending on the project, constructing the model what might take a lot of time and effort. And so the bottom line is, will you really get a better valuation going into some kind of complex real option? So it might be better just to do some kind of rough approximation that will be easier to explain to others and to really make sure that everyone understands what's assumed in the model or the valuation. The other thing that how real life can make this more complicated is that there may be a lack of structure. What do I mean by this? Well, the ones that I've, or at least the examples I've modeled out, is they were cut and dry choices between projects and what your next decision options were. So there may not be specific steps. Or specific decision order. And then the other thing to be very clear on is competition. So we've been ignoring the strategic response of our competitors. So just like we as a firm might see prices moving in the right direction for us, all of our competitors are going to see that same trend and going to be wanting to jump in the market at the same time. So essentially, you're going to have to, when thinking about competition, you might have to bring to bear some of the things that you've studied from game theory to figure out how that complicates decisions and option values. And that is all I'm going to cover for real options.